Welcome back to the Corporate Finance Academy. Today, we are going to go through cash flow forecasting, talking about how you do a forecast or a budget on a 5-year income statement in Microsoft Excel. So what we're going to talk about, this is how you do a 5-year budget on your cash flow statement. And what you're going to see is this is really linked and kind of an output of your income statement and the balance sheet that you've already forecasted in our other videos. You can get the link below in the video description. We're going to show you how to think about the assumptions, but it's pretty straightforward for the cash flow, and then we're going to show you how to actually do it in Microsoft Excel. So we're going to jump right into it. So by the time you get to the cash flow statement, you've already forecasted your income statement and your balance sheet. And you can see the videos for how we did that. The link is in the description below, and I think you can click up here in the screen. But when we get to the cash flow statement, what you'll see is a lot of it is linked to things you did before. So if we start out, the first line of an indirect cash flow statement is net income. So we've already done net income, which is up here in H42. Next, you've got depreciation and amortization, which is up here as well in H33, 2,286. And we have a separate tutorial on the cash flow statement. If this indirect method is new to you, you can click on that link to learn a little bit more about the indirect cash flow statement. So the next thing we have to do is look at our changes in working capital. So first, we have AR. So if you scroll up to your balance sheet for accounts receivable, you've got 13,789 going to 13,836. So your accounts receivable is actually going up when you take G49 minus H49. What's happened here is your accounts receivable, you've got more money outstanding that you haven't collected, which is a cash pressure. Next, you've got inventory. So if we scroll up to inventory, we see we've got 11,315 in inventory versus 11,092 before. So again, we've got more money in inventory this year than we did last year, which means that we haven't sold as much or generated as much cash. So that's a cash flow pressure. And then we have AP. So if you scroll up to AP, you can see that last year's balance was 7,124 and this year's is 5,126. Now with accounts payable, if I'm paying my suppliers more, that will reduce our AP. So I've actually paid more suppliers, which is cash out of my pocket. So for accounts payable, your formula is the opposite of the prior to working capital accounts, where now I'm actually going to say 5,126 minus 724, so H minus G. You can see all three of our working capital accounts are actually going the wrong direction that you would hope. Now what we can do here is these are all formulas, so we can drag these across, and that'll give us our cash flow each year. For purchases of property, plant, and equipment, you would have already forecasted this when you were trying to forecast out your balance sheet and probably your income statement as well for depreciation expense. So if we flip to our assumptions, you can see that when we forecasted PP&E and depreciation expense, we planned a capital expenditure of $1,500 to $1,275, etc. So when you're spending $1,500, you'll have to make this a negative. So you can see we had a negative sign in front because that's a cash outflow. Drag that to the right. Now you get to cash flow from financing activities. The first is debt. So when we scroll up, you can get this from your change in debt. So if you see here, we're taking H60 minus G60. So that's a $500 change. And then we're taking H63, which is the long-term debt, minus G. So this is just short-term debt and long-term debt. give you your full debt, and then you do for stock, you do the same thing, your change in your common stock. And we didn't pay any dividends, so that one is simple for the purposes of this. So that's it. So this will give you your change, increase or decrease in cash. So you had your cash at the beginning of the year, which would be your cash from the balance sheet. You get your change in cash, and that gives you your cash at the end of the year. What we do here is we check if H101, which is our cash at the end of the year, is equal to H48, which is our cash and equivalents balance sheet balance, and that gives you a double check. So that is your cash flow statement. The last of the three statements were in forecast. Again, you start through net income, you add back depreciation, you get your changes in working capital, and that gives you your cash flow from operating activities, which in this company is pretty healthy overall. 1 year that's flat, but overall good. Cash flow from investing activities, where we're spending consistently some money on property, plant, and equipment. And then our cash flow from financing activities, which you see negative cash flows here, but in reality, what this is doing is you're driving down your debt, which can be a good thing for your business, depending on what you're going for. And then you have your overall increase or decrease in cash for the year, which again is a pretty good story other than the 1 year. Pretty simple. Derivatives from your income statement and your balance sheet gives you your cash flow statement. Again, there are ways to be more detailed and more granular here, but this is a good overview of how to do a 5-year budget. So that's it for our cash flow budgeting, and this is the third of our 3 videos on how to do a 5-year budget. You can see the other links in the video description. Please subscribe, like, or dislike, and make sure you leave any questions or comments. We'd love to hear from you.